Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, earlier this week, I was in Riyadh for an investor conference, and while there was, of course, a lot of discussion on the region's outlook, as one might expect, one of the biggest questions still was about the US, and specifically whether the US economy could achieve a soft landing, and specifically what the Fed policy outlook would look like from here. I'd say it was certainly topical, given that looking ahead, we're heading for an extraordinarily busy week as far as the central bank calendar is concerned, including a key Fed meeting. So, how should investors approach this period? To discuss this today, I'm joined by Rajat, who's a senior investment strategist at the CIO office. So, welcome, Rajat. Thanks for joining us today. Really heavy week for central bank meetings next week. The ECB's already cut rates for the second time this cycle. What are you expecting from other major central banks and the impact on markets?
Hi, Manpreet. Yes, glad to be here. Indeed, three major central banks are scheduled to meet next week. ECB, as you said, has already met and cut rates for the second time in the cycle. Of the central banks meeting next week, the Fed is the big one. It's likely to start cutting interest rates for the first time in this cycle, while the Bank of England and the Bank of Japan are also likely to meet, but they are likely to hold rates. Now, markets have already anticipated the Fed rate cuts, and as a result, the dollar and the US bond yields have fallen significantly in recent months. In fact, both the dollar and US rates, the bond yields, are at pivotal points right now. The US dollar index, also called the DXY, is close to the bottom of its 1 year range, while the US 10-year bond yield has fallen below the 3.8% mark it has been holding since December last year. And this is because of rising concerns about the outlook for US economic growth. Now, the monetary policy sensitive 2-year government bond yield has slumped more than 130 basis points over the past 3 months. Now, we believe the latest bond market moves have been excessive, given our core view of an economic soft landing in the US rather than a recession. And as a result, the key conclusion from all of that is that we would refrain from adding to US government bonds at this point in time.
Okay, so let's maybe dig a little deeper into the Fed. A lot of debate about quarter point or half a point as the first rate cut. What's your view?
Yes, I think that's a crucial question now. Markets have been pricing at some point almost 50% chance that they would cut rates by 50 basis points. We don't think that's likely. I think they're going to start with a 25 basis points cut. And why do I say that? So the latest US job market and inflation reports have come out, and what they make it almost clear is that while the job market is slowing, inflation has surprised to the upside on a month-on-month basis, and this is core inflation. Now, while US economic activity is clearly slowing and this justifies the rate cut, the job market has generated an average of almost 116,000 jobs over the past 3 months, a pace which is not really consistent with recessionary concerns at the moment. Meanwhile, as I said, core inflation at 0.3% month on month in August surprised to the upside due to a surge in shelter costs. However, the annualized 3-month average of core inflation remains close to the Fed's 2% inflation target, while the annual headline inflation continues to decline. The forward-looking job market indicators, on the other hand, such as the job openings rate, are weakening, which, if sustained, could raise the urgency for the Fed to cut rates at a faster pace. But for now, we're going with the 25 basis points rate cut. Now, what is important to see is, apart from the rate cut that I mentioned, is the new Fed projections. They make these projections every 3 months, and in September, they're going to make a new set of projections, and especially on the guidance on rates. and this is what sets the markets going. Now, money markets are pricing in almost 100 basis points of rate cuts by the end of this year, and a total of 250 basis points of rate cuts by the end of 2025, implying about 125 basis point rate cut for each of the 11 policy meetings until the end of next year. Now, Fed guidance confirming this gradual pace of rate cuts is likely to be seen as positive for risk sentiment and equity markets. However, if they start with the 50 basis point rate cut next week, it could potentially spook the markets because it could sustain further downside in bond yields and the dollar, and it could lead to expectations that the Fed is worried of economic growth more than what the market is expecting.
Okay, maybe shifting gears a little bit now. Let's move on to US politics. We had, of course, the debate between Harris and Trump. Are there any implications investors could draw from that recent debate?
Yes, so U.S. Vice President and Democrat nominee Kamala Harris had this debate with the challenger President Donald Trump. Now, from the polls after the debate, it seems that Harris has emerged as the winner. Now, the race is still too tight. The two candidates are still polling similar chances of the winning in the November elections, and it's too close to call, and a lot could change in the next 2 months. A Harris presidency, in our mind, would signal policy continuity and reduce policy and geopolitical tensions. A Trump presidency, of course, would raise the geopolitical tensions. It could be positive. There is an element that the chance that the Trump presidency could be positive, but for that to happen, Republicans will also win both houses of the Congress so that they can cut taxes. Now that winning the White House plus two houses of Congress looks very difficult at this moment.
Okay, so I guess we logically, move on to markets, building right off that. So, technology sector, it has recently underperformed in the US. Do you see any upcoming catalysts that could help reverse that underperformance if it's not politics?
Yes, so there was this underperformance. US technology has lagged the broader market in H2 after having doing very well in the first half, of course. Now, this recent lag has occurred amid market concerns about the sector's elevated valuation and doubts about how the significant investments into AI will be monetized. We believe it is reasonable to expect some near term consolidation and volatility in the technology sector after what has been a very strong run this year. Having said that, we expect superior earnings growth to drive the technology sector higher over the next 6 to 12 months. Data center capex looks set to continue into 2025, driven by AI related investments, with high end semiconductor makers having to deal with tense customers scrambling for limited supply, as we saw with Nvidia recently. There is scope for the market to expand as governments and corporates increasingly explore the use of AI. Software applications are also in early stages of using AI to enhance productivity. Meanwhile, device makers, including smartphones, PCs, wearables, should continue to roll out AI-featured the themes and products in their systems over time. All of these factors should drive structural growth for the technology sector, even as the Fed rate cut helps mitigate valuation concerns.
All right. And then maybe finally, just on US banking sector, we saw some caution from guidance at recent earnings. Do you see any risks to the overweight on the US financial sector equity in US equity markets?
Yes, indeed. The U.S. financial, especially the bank sector equities, fell last week after some major banks said consensus earnings expectations, particularly for the next year's net interest income, may be too optimistic. However, we expect a soft landing to benefit U.S. financials. And why do we say that? A steeper yield curve, which is the gap between the long and the short maturity bond yields, should mitigate any negative impact from Fed rate cuts. Second, this recovery in non-interest income is likely to partly offset weaker net interest income. And by non-interest income, we mean the trading income. This is likely to lead to this is likely to be led by a recovery in investment banking over the next couple of years. A soft landing in the US economy and lower rates could also help drive loan volume growth for the banks. So, in our view, the US financial sector is reasonably valued with 12-month forward P of almost 15.4, which is almost a quarter uh, discount, almost a 25% discount to the broader market, and in line with historical average discount. So we expect the US financial sector to outperform the broader market over the next 6 to 12 months and see the recent correction as an attractive opportunity to add exposure to US major banks.
All right. Well, thanks, Rajat. I think we're about out of time, so we'll end it there. Thanks for taking the time to join us today. As usual, if I can just summarize the top takeaways from our conversation today. First, of course, very central bank heavy week ahead, but one key element to focus on is updated Fed projections. That may be key to the path from here. Second, of course, the US technology sector. Some near-term consolidation seems reasonable, but the structural outlook remains quite interesting. So that's something we'd consider for investors with long horizons. And finally, of course, the US financial sector is something we still like because of our view low rates could be offset by a steeper yield curve. So potentially a sector to examine to add on pullbacks. So with that, we'll bring the conversation to an end today. Thank you very much, listeners, for taking the time to join us. And we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.